Hello everyone. In this video I'm going to cover chapter 6 just like I did with chapter 5 by recording my voice over the slides and writing things to enhance the understanding of the material. This chapter has to do with variable costing, and this variable costing is opposed to what we have learned in chapters 3 and 4. Chapters 3 and 4 we had the job order costing and the process costing accordingly. Both approaches of costing are they belong to the family of absorption costing. And in absorption costing, we call it absorption because the product cost absorbs all the product cost absorbs all. Okay, so in absorption costing, the product cost includes, so the product cost includes direct material, direct labor, and manufacturing overhead. And this manufacturing overhead has the fixed component and the variable component, right? In the variable costing, unlike the absorption costing, this component over here, the fixed manufacturing overhead, is not part of the product cost. So an income statement that follows that follows variable costing would have revenues minus variable cost or costs, and this includes several items like direct material, direct labor, variable manufacturing overhead, and so on. This will get us the contribution margin. You deduct from it total fixed costs, and these fixed costs might be something like rent and something like fixed manufacturing overhead, like the maintenance of the factory or depreciation if it's fixed. This will get us net operating income. So the main difference between variable costing, which is chapter 6, and absorption costing, which is chapters 3 and 4, is that under absorption costing, the product cost consists of direct material, direct labor, manufacturing overhead in its fixed and variable forms. However, under variable costing, the variable cost includes direct material, direct labor, and only variable manufacturing overhead. And when I say variable cost, I'm referring to the variable cost of production. This is the first part of the chapter. The other part has to do with segment reporting. This is simpler and easier. Basically, if you have a company that, for example, let me call it ABC company or incorporation, and they sell TVs and laptops. Each division of these two divisions has its own costs and accordingly its own segment margins or profits if you want, and both of them together they have some common costs. So we will learn how to prepare an income statement that shows whether the TV division and laptop division are being, each one of them is being profitable, and what are the revenues and costs referring to each one of them. So the first part will explain how variable costing differ from absorption costing and compute unit product costs under each method. So variable costing versus absorption costing. Again, this is chapter 6 and this is chapter 3 and 4. We had the job order costing in 3 and the process costing in 4. Okay, you can. There's nothing to explain here. Okay, so variable costing, you know that we have direct material, direct labor, variable manufacturing overhead, fixed manufacturing overhead, and these 4 components, which are DM, DL, and MOH, they are all part of the product cost under absorption costing, and this is what we've been learning so far in this course. Under variable costing, the product cost comprises direct material, direct labor, and only the variable component of manufacturing overhead. However, the fixed manufacturing overhead goes to the period cost. So if you prepare an income statement, as I said, revenues under variable costing minus DM, DL, and variable manufacturing overhead to get the contribution margin. Then you deduct the rest of the things, which are the fixed manufacturing overhead and so on. Okay, under absorption costing, it's not the case. You have here, instead of this, you will have revenues minus cost of goods sold, and you will get the gross margin or profit. And this cost of goods sold has these 4 components. So the full manufacturing overhead and direct material and direct labor. So which method will produce the highest values for work in process and finished goods inventories? Absorption, variable, they produce the same values of inventories, and it depends. So if you think about it, under absorption costing, the product cost has an additional component. This one, it includes DM, DL, variable manufacturing overhead, and fixed manufacturing overhead. However, variable costing has DM, DL, and the variable component of manufacturing overhead. So it makes sense that this one here, the absorption costing, will have a greater value in work in process and finished goods. So WIP and FG will have greater values under absorption costing. Now, the given says, Harvey Company produces a single product with the following information available. Number of units produced annually is 25,000. Here we need to distinguish very well between the number of units produced and the number of units sold. Okay, so they produce 25,000. They might sell 20,000 and they might sell 30,000. How that's possible? Simply they have some beginning inventory. So if they have 5,000 in the beginning inventory, it means that they can sell up to 30,000 units. So that it might be the case where they produce 25,000 and at the same time they sell 30,000. Variable cost per unit, they told us that the given says direct material, direct labor, and variable manufacturing overhead is $10. Variable selling and admin expenses is $3. As for the fixed costs per year, manufacturing overhead, fixed manufacturing overhead is $150,000, and fixed selling and admin expenses is $100,000. So now if you want to prepare a contribution format income statement, you should have revenue as Q multiplied by P minus variable costs, right? And variable cost is basically Q multiplied by the sum of DM, DL, variable manufacturing overhead, and the variable selling and admin expenses, which is the 3. So the sum of these 4 components here is $13, right? The sum of these 2. Okay. So let's move. So the given says absorption costing and variable costing, and we are computing the product cost in each of them under each approach. Under absorption costing, the product cost consists of direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. So the 4 components, and the sum of the 4 components is $16. Now, this 6 over here was computed per unit by simply dividing the $150,000 for fixed manufacturing overhead and dividing it by the 25,000 units that were produced. So this is the 6. It came from dividing the total by the number of units produced. As for the variable costing, this 6 doesn't exist because fixed manufacturing overhead is not part of the product cost. We only include variable costs that vary with the production. So if you think about it now, an income statement prepared under absorption costing, the cost of goods sold will include 20. Let's assume that this company sold 20,000 units. So 20,000 units multiplied by 16. And under the fixed components in the income statement, so this is a minus, this is a minus, you have revenues at the beginning. The fixed will not include the fixed manufacturing overhead anymore because it was already included in the $16. However, under variable costing, you will have the same revenue minus the cost of goods sold will have 20,000 units multiplied by $10. But then you will have, under the fixed component, the $150,000. So the fixed component under variable costing will have the $150,000, right? So under variable costing, the 150 were included in full. However, in absorption costing, out of the 150, we included only 20,000 multiplied by 6, which is the fixed manufacturing overhead portion. So 20 multiplied by 6 is 120,000. So here the variable, the fixed manufacturing overhead under absorption costing is 120,000, and under variable costing, the fixed was 150,000 because it doesn't vary with production. However, this one varies with production. So this is the main difference between these two. You will see what exactly this is supposed to mean in the following. Now, prepare income statements using both variable and absorption costing. And this is what I was explaining in the previous slide. Let's assume that following additional information for Harvey, okay, so they sold 20,000 units and the selling price is $30 each. So the price is equal to $30. And there is no beginning inventory, so we produced 25,000. So production 25,000 units, and the selling or sale is 20,000 units. So we were left by ending inventory of 5,000 units. Now, under variable costing, you will have a sales of 20,000 that were sold multiplied by $30. Variable cost of goods sold is 20,000 multiplied by 10, and this 10 was computed in a couple of slides before, which consists of direct material, direct labor, and variable manufacturing overhead only. Then you will have the selling and admin expenses, so the $3 that was also given multiplied by the 20,000 units that were sold. This will give us a contribution margin of $340,000. Less fixed expenses. Fixed expenses are the fixed manufacturing overhead in full and the fixed selling and admin expenses also in full. So the difference between variable costing and absorption costing is that here we are including in variable costing the fixed component of manufacturing overhead in full, regardless of the number of units sold. So this 150 will always be included regardless whether you sell 5,000, 10,000, 25,000 or more. So eventually we reached a net operating income of $90,000. Memorize this please for a moment. The net operating income under variable costing is $90,000. Under absorption costing, you have the same sales, so $30 multiplied by 20,000 units. Cost of goods sold is 20,000 units multiplied by 16. And this 16 includes direct material, direct labor, variable manufacturing overhead, and the fixed manufacturing overhead per one item, which is $6. Remember, this was 6, and the sum of these three was 10, and these numbers were given. So now under this will yield a gross margin of $280,000. Then we need to deduct the selling and admin expenses. Selling and admin expenses under absorption costing, they have two components. The variable component, which is the 20 multiplied by 3, and the fixed component. Remember that this number here, the variable selling and admin, was included before reaching the contribution margin under variable costing, right? Because we were grouping all variable costs over here before reaching the CM and not the gross margin. Fixed component is 100,000, and this was given as well, and this is common between variable and absorption costing approaches. And eventually we reached a net operating income of $120,000. So the net operating income for the absorption is $120,000, and the net operating income for the variable costing was equal to $90,000. So obviously net operating income for the absorption is higher than that for the variable, and the difference between them is $30,000. Now this difference, the source of this difference, comes due to the fact that under absorption costing we included only part of the total fixed manufacturing overhead. So instead of including fixed manufacturing overhead as $150,000 in the fixed part, we included 6 multiplied by the number of units that were sold, which is 120,000. So the difference between this 120 and this 150 stands behind the difference between net operating income between absorption and variable. Okay, so these $30,000 now, where do they reside? Remember that we produced, the production was 25,000 units, and the sale was 20,000 units. The difference between these two is 5,000 units in ending inventory, right? Because we did not sell them. So ending inventory or inventory includes these 5,000 units. Each one of these units includes or has $6 in fixed manufacturing overhead. So fixed manufacturing overhead for this ending inventory, is equal to 5,000 units multiplied by $6, which is equal to $30,000. And this is the difference between the net operating income between absorption and variable. Therefore, we conclude that the difference between absorption and variable net operating incomes resides in the fixed manufacturing overhead component of ending inventory. Okay, please remember this very well. Try to understand this slide carefully because it's the pillar of the chapter. Now, reconciling the variable cost and reconciling variable costing and absorption costing net operating incomes, and explain why the two amounts differ. I already explained that and established that the difference resides in the ending inventory, but let's say what they've got. So they are telling us that the cost of goods sold under absorption costing includes the variable manufacturing expenses, which are the M, the L, and variable manufacturing overhead, right? Let me just to be okay. So this variable This variable manufacturing expenses are DM, DL, and variable manufacturing overhead. The fixed manufacturing overhead expense is $120,000, and this number over here, instead of being $150,000, it is 120 because we multiplied the number of units that were sold by the $6, which is the fixed manufacturing overhead per 1 unit. And therefore, the total cost of goods manufactured under absorption costing is $320,000. The ending inventory under absorption costing has $50,000, and this number over here is basically the remaining 5,000 units multiplied by the $10, which is the sum of DM, DL, and variable manufacturing overhead, and this was given in the first slide. This $30,000 apparently is the 5,000 units remaining in ending inventory multiplied by the $6. Now, this is the reason why we have a difference in the net operating incomes between the absorption costing approach and the variable costing approach, and I established this in the prior slide. Okay. So yeah, this is why this is the absorption net operating income, the 120,000, and this is the variable net operating income, and the difference is the fixed manufacturing overhead component, fixed manufacturing overhead cost, residing or deferred in ending inventory, the 30,000. Now, a logical question here is that, is it possible for variable costing to have a net operating income that is greater than that of the absorption? The answer is yes, and this happens when you sell more than what you produce. So far we produced more than what we sold, and therefore the net operating income for the absorption is greater than the net operating income for the variable costing. However, if you produced less than what you sold, and this happens in the case when you have beginning inventory, the net operating income is the opposite. The net operating income of the absorption will be less than the net operating income of the variable for the same reason. The fixed manufacturing overhead component residing in ending inventory. So in year 2, now we have the same company, but in year 2. So they produced also the same number of units, 25,000 units. However, this time, instead of selling 20, they sold 30. And they were able to sell more than what they produced because the beginning inventory had 5,000. So the ending inventory in year 1 is the beginning inventory in year 2. Therefore, they sold all of these, what they produced in year 2 and what they had in their beginning inventory or ending inventory in year 1. The same given applies. So unit selling price, the variable cost per unit in terms of production, the selling and admin, $150,000 manufacturing overhead, fixed manufacturing overhead, and the fixed component of selling and admin expenses. So the same given, but this time we sold more than what we produced. Also, this thing, you've seen it before, it's the same. Now, under, let me try to get rid of these. Okay, doesn't matter. So this is variable costing, income statement. We sold $900,000, which is the $30 multiplied by the 30,000 units. Our variable cost of goods sold is 30,000 multiplied by $10, which is the product cost. Our variable selling and admin expenses is $3 multiplied by 30, and these numbers are given, okay? Given that we deducted from the revenues all variable costs and expenses, we will get the contribution margin, the CM, which we dealt with thoroughly in chapter 5. Our contribution margin is $510,000. Deduct $150,000 as fixed manufacturing overhead and fixed selling expenses of $100,000. Your net operating income is $260,000. Remember this number carefully. Now, before moving forward, let's think of the fixed manufacturing overhead under absorption. Under absorption, it's a function of units. So we have 30,000 units multiplied by $6, right? Which is the fixed manufacturing overhead per 1 unit. So this $6 now will appear in the fixed manufacturing overhead for the units that were produced, which is the 25,000, and the units residing in beginning inventory, the 5,000. So you will have a fixed manufacturing overhead cost of $180,000, which is greater than the $150,000 that you see under variable costing. So under absorption now, you will have a higher cost by 30,000. So you would expect a net operating income for absorption costing that should be equal to 260,000 minus 30,000. So 230,000. Let's see that. So under absorption costing, you know that the same sales apply. Cost of goods sold is the same number of units multiplied by the 16, and this 16 includes the MDL, variable manufacturing overhead, and the fixed manufacturing overhead, which is the source of the difference between the net operating incomes. So your gross margin here is $420,000. Then you deduct the variable and fixed selling and admin expenses, and you will get a net operating income eventually of $230,000. And as I told you, the difference between the 260 under variable costing and the 230 under absorption costing is due to the $6 that were deferred in the ending inventory in year 1 or the beginning inventory in year 2. So eventually, if you think about it, in year 1 and in year 2, the sum of the production and the sale was 60,000, which were equal. So net operating income of absorption in year 1 plus year 2 is equal to the 120,000 in year 1 plus the 230,000 in year 2. The net operating income for variable in years 1 and 2, 90,000 plus 260,000. Those numbers will give us 350,000 in both cases. So this is the case when you have the same number of sale, so units sold is equal to units produced. So the net operating income will be equal between both. We should see the coming slides. So this is how they reconcile the cost, and the difference is here simply by multiplying 6 by 5,000. This is what I was saying. In the first period or first year under absorption costing, you had a net operating income of 120. Then in the second period, you had 230. In the variable costing, the first period had 90,000, and the second period had 260,000. So summing these together will give us a 350,000, and summing these together, first period and second period will give us the same number. The reason here why we have a net operating income for absorption greater than that for variable is that the units produced is greater than units sold. On the other hand, here the units produced was less than units sold. Okay. This is a chart where it summarizes how the net operating income will be different between absorption and variable costing, depending on the number of units produced and sold. Remember that when they are equal, the number of units sold and produced, you will always have the same net operating income under absorption and variable, and the rest were covered previously. This for you to read. Okay, now the other part of the chapter has to do with segmented income statement that differentiates between traceable fixed costs and common fixed costs. So please keep in mind these two concepts: traceable fixed costs and common fixed costs or expenses. I'll give you an example before we proceed. Let's assume that we have one store that has two levels. So level 1 and level 0. This is the same store. On level 1, we sell laptops. On level 0, we sell mobile phones. Okay. The whole store has a fixed rent, monthly rent, let's say, of $6,000. Okay. So this fixed rent applies to the store. So this is a common expense for the laptops division and the mobile phones division. So this is called a common fixed cost. However, the salary of the supervisor of the laptops division, so salary of managers, assuming that the guy that supervises the laptops division gets paid $2,000 a month, and the guy that supervises mobile phones gets paid $1,800,000. This number is traceable to the laptops division, and this number is traceable to the mobile phones division. So these are called traceable fixed costs. They can be traced to the division itself. This one can be traced to the division itself. However, the $6,000 applies to both. So it's common. It cannot be traced. Okay? So this is the concept and the difference between traceable and common fixed costs. This is basically paraphrasing what I was saying. Same applies here. Examples of traceable fixed costs, I spoke about that. And this is an example of common fixed costs. For example, the CEO of General Motors is a common fixed expense for all types of cars. So the production line of car 1, production line of SUVs, of sport cars, and so on. This is a common fixed cost. Traceable, okay, so we gave a lot of examples on traceable. Segment margin. The segment margin is basically the contribution margin for a specific division. A specific division. Okay, as simple as that. So the segment margin refers to laptops. This has a segment margin, and mobile phones has another segment margin. So each one has a specific profit from sales before deducting common expenses. See an example in a minute. Here they are telling us that we should not allocate common costs to segments. So the $6,000 rent cost in my example should not be allocated to laptops or neither laptops nor mobile phones. Now, the example says that Weber Incorporation has two divisions, computer division and television division. Let's look more closely at the television division's income statement. So they have the contribution format income statement, of course, sales 300,000, variable cost of goods sold, variable other variable expenses. This gives us a 150,000 as contribution margin. Traceable fixed cost is 90,000, and the division margin is 60,000. Here we're talking about the television division only. So the television division only includes the traceable fixed expenses to this division. As for the other division, it has a different traceable fixed cost. The division margin is exactly the segment margin, which is similar, or it's similar to the contribution margin, but for a specific division or segment. Okay, so yeah, story. Now this is the whole company. It has televisions and computers. And as you can see, traceable fixed costs for each of them is given separately, 90 and 80. The sum of them is 170,000. This is the sum of traceable fixed costs for both televisions. So this is the whole company, as you can see. Now, the whole company has some common expenses that cannot be traced to either division, such as the rent of the whole company or the headquarters or whatever. This is the common fixed expense, and this is the traceable fixed expense or fixed cost. So the common is $25,000, and therefore the net operating income for the whole company is $75,000. And they are stressing the point that common fixed expenses should not be allocated to the divisions. Okay. Now, under one of the divisions, the television division of this company, we have two product lines, regular and big screen. So regular screen and big screen under the television division. So this is the television division's income statement. This is a partial income statement because the television division is part of Weber. So now we have Weber, and Weber has laptops and television, or whatever, what was the other one. And television itself has regular and big screen. Okay. Also now under big screen you can have, for example, LED and plasma and so on. So the regular division under subdivision under the television division has a product line margin or a segment margin of 60,000, traceable fixed cost 45. The other one, the big screen, 35,000 traceable and 10,000 traceable fixed costs, or sorry, 10,000 product margin or segment margin. Now the common expense over here for the television division will be a traceable expense in the income statement for the whole company, because this is common for this division, right? But it is traceable for this division when you have an income statement for the Weber company in full. Let me tell you what does it mean exactly. So the sum of these two, the traceable fixed cost and the common fixed cost, is 90,000. And this 90,000 were traceable fixed cost for the income statement under television division when we had it as part of the Weber company. So we had Weber laptops and TVs, and then we have traceable fixed cost. We have this is as 80,000 and this is as 90,000. This 90 now is divided into partially 80,000 as traceable to regular or big screen, and the rest, the 10, are common for both divisions. Okay, so here they are basically telling us if there is a 5% increase in sales, the margin will increase by 5% in each of V2. the division margin increases by this value, and we have an additional $5,000. Okay, this is very similar to what we learned in chapter 5. I will not go through details because this is simple. This is quite simple compared to what we dealt with in Now compute company-wide segment break-even points for a company with traceable fixed costs. Remember that if you want to get quantity to break even, you will have a total fixed cost divided by unit CM. If you want sales to break even, you need to have total fixed cost divided by CM ratio. These are from chapter 5. I'm just reminding you about them. So this is the income statement of the company for the whole company, and we have two divisions, television and computers, and we have traceable fixed cost for the television 90, for the computer it's 80, the sum of them is 170, then common expenses for both that cannot be assigned, 25,000. Okay, so the company's break-even point, if they want it in terms of, okay, so they are calculating it in terms of sales dollars, so it will be equal to the total fixed cost divided by the CM ratio. CM ratio is equal to CM divided by sales, so this is CM and these are sales, and therefore the total fixed cost now is equal to the common and the traceable. When you want to calculate how much do I need to sell in order to get a profit of 0. Okay, now if you want to calculate for each business segment, you will simply have, for example, sales break even for the television. You should have total fixed cost of the television, which is 90, divided by the CM ratio of the television, which is 150 divided by 300, so you're dividing by a half, and basically this will become a $180,000. Let me see if they did the same. Exactly, this is for the television, 90 divided by 0.5, and 80, which is the traceable fixed cost for the computer division divided by the CM ratio of the computer division. So this is what you need to sell in order to break even in the computers division, and this is what you need to sell to break even in the television division. Okay, I think this is the vast majority of the chapter. We're almost done. Yeah, this is another example just to make sure that we got the idea. So we have a company. They have a bar and a restaurant. And this is the full or the consolidated income statement for the company. Okay, obviously the size of the restaurant and operating size of the restaurant is much bigger than that for the bar. You can tell from the revenues and the expenses, and of course net operating. How much of the common fixed expense of $200,000 can be avoided by eliminating the bar? We know that it's none of it because this is common. It's not traceable to any of the divisions. Suppose that square feet, so area, is used as the basis of allocated the common fixed expense of $200,000. So this $200,000 are allocated to the bar and the restaurant based on the area of each. How much would be allocated to the bar if the bar occupies 1,000 square feet and the restaurant 9,000 square feet? So obviously here it's a total of 10,000 square feet. The bar has 1,000 and the restaurant has 9,000. So this is for the bar multiplied by the common fixed expense, 1/10 of the 200,000. So far it's logic and not accounting. If the company allocates its common fixed expenses to the bar and the restaurant, what would be the reported profit of each of them? So now it shows that if you allocate these $200,000 based on area to the bar and the restaurant, it shows that the bar is yielding a loss of $6,000 while the restaurant is still profitable, and of course the whole company is still profitable. Now the following question would be logically eliminate the bar. Exactly. So that should the bar be? Now the answer is very simple. If you eliminate the bar, you will be losing its net operating income, and the $200,000, which are the common fixed expenses, will stay there. So apparently you should not eliminate the bar because you will be $14,000 as which were the segment margin. Here you had a segment margin of $14,000. If you eliminate the bar, you will lose these $14,000 and these 200 will stay there. So your net operating income will decrease by 14,000. It was 44,000 and now it has become 30,000. So you made a loss of 14,000. So you should not eliminate the bar. The rest of it are more like a reading that you can read and incorporate and digest at your ease. This is the end of chapter 6. I'll see you with a new video with chapter 7. Thank you so much.